And now that Orion Telescopes has whittled down their potential projects to 4, they can further analyze those 4 remaining projects, projects B, C, D, and F, using another technique. And the next one we're going to proceed to is the accounting rate of return. Under the payback method, we completely eliminated projects A and E from consideration because they don't meet our 4-year maximum payback period, which means there's no point in even trying to do the ARR calculations for those 2 projects. Even if they come up with a good number, they've already failed one of our screening tests, which means we only need to do the ARR calculations for projects B, C, D, and F, the remaining acceptable projects which passed the payback period. So let's make this happen. Make this a little bit bigger here. There we go. For projects B, C, D, and F, the first thing we need to find to do our accounting rate of return is the average annual income. So for project B, we need the sum of the net cash inflows from that project. Well, we just found that on the payback tab. If we go back to our payback tab, we see that project B is going to bring in a total of $210,000 of accumulated net cash inflows, or the sum of their net cash inflows. So we bring that over. From those net cash inflows, we need to subtract the depreciation we're going to record over that project's life. What is the amount of depreciation that is recorded? It's the loss in value from all the things that we need to undertake that project. And back to our info tab, what it is the difference between what we expect to have to pay out on day 1 of the project and what amount of residual we expect to receive at the end of the project's life. So for project B, going back to our ARR tab, the depreciation over the project's life is the difference between the $140,000 we have to outlay on day 1 and the $10,000 we will receive at the end of the project's life. We're going to record $130,000 of the depreciation during the life of project B, which means that its operating income is going to be the difference between those 2 numbers. The operating income contribution that we're going to get from project B over its entire life is going to be $80,000. So on average, how much is that going to be each year? Well, all we need to do is divide how many years that particular project is expected to provide us positive net cash inflows. And back to our project info tab, we see that project B has a life of 6 years. So if it's going to bring us $80,000 over the span of 6 years, that means that on average, project B has an average annual income of $13,333 per year. We did not eliminate project C. Its 3.56 year payback period is less than 4, so we need to do ARR for that particular project, and we're going to do it in the same exact way. The sum of net cash inflows for project C can be found on the payback tab. We see that in total, project C is going to bring us $90,000 of accumulated net cash inflows. We need to subtract the depreciation over its operating life, which we can find on our project info tab by taking the difference between our initial investment, what we're going to have to pay on day 1, and any residual that we have at the end of the project's life. Well, project C does not have a residual value, which means we are going to record depreciation for the entire $80,000 initial investment in that particular project. And if it's going to bring us $90,000 in cash inflows, and we're going to depreciate $80,000 over the project's life, then in the long run, project C will end up contributing $10,000 during its life to the company's operating income. That's for the entirety of its life. So to figure out on average what it's going to provide each year, we need to divide by how many years we're going to have cash inflows from that project, and that answer is 4. So if we're getting $10,000 in total over the span of 4 years, we take 10,000 divided by 4. That means on average, project C is going to provide us an increase to our average operating or annual operating income of $2,500 per year. Next up, we have project D, which also passed the payback test. So we need to do ARR for project D. We're going to start by finding its average income. So start with the sum of net cash inflows. Back to the payback table. Project D is going to provide us $280,000 in total over its life in terms of net cash inflows. How much depreciation are we going to record for project D? Well, it's the difference between its initial investment, its historical cost, in its residual value. Project D also does not have a residual value, which means we are going to depreciate the entire $200,000 that we have to invest in that project. And therefore, if it's bringing us $280,000 in total, but costing us $200,000 up front, then over its entire life, Project D is going to contribute $80,000 to our operating income. Well, how many years will Project D last for? We go back to this and we see that its life is 4 years. So if this project is going to provide us an $80,000 increase to operating income over its 4-year life, if we take $80,000 and divide by 4, we determine that its average increase to our annual operating income over its life is going to be $20,000. Moving on to Project E, we go to the Payback tab and we see that Project E, with its 5-year payback period, has failed the payback test. So Project E is already eliminated from consideration. We're not going to undertake Project E. We don't even need to bother doing ARR for that particular project. Project F passed the payback test, which means we need to determine our average annual contribution to operating income from this particular project so that we can determine our ARR, because it is still in the running to be considered to be done. So let's go back to our ARR tab. What is the sum of net cash inflows from Project F? Project F is going to provide us a total of $70,000 worth of net cash inflows over the project's life. What amount of depreciation are we going to record? Let's go to our Project Info tab. Project F costs $60,000 up front, but at the end of the project's life, we're going to sell off any equipment specific that we had to buy to undertake this particular project and get $5,000 back. So in total, we're going to have to pay out $55,000, the difference between those two numbers. In terms of expenses over the project's life, that is going to be its depreciation. So in total, if it's bringing in $70,000 of inflows in cash, but it's costing us $55,000 to undertake, that means that over the life of the project, Project F is going to increase our operating income by $15,000. Well, if we go back to our Info tab here, we see that that project has a life of 3 years. So if we're getting $15,000 over the span of 3 years from Project F, that project is going to increase our annual operating income on average by about $5,000 per year. So that's part of what we need to determine our accounting rate of return. The other part is the average amount that we are going to have invested in the project at any one given time. And to do this, what we need to do is we need to go through and we need to figure out what that amount is going to be based upon how much we're going to have tied up in that project on the first day and how much we're going to have tied up in that project on the last day. So if we go to Project B, Project B's initial investment is $140,000. Its residual value was $10,000, which means it's going to be worth $140,000 on the first day and $10,000 on the last day. And as we periodically record depreciation on that project, the total value we have is going to be going down. So to find our average amount invested, we add together our initial investment and our residual value. It's going up with $150,000, and we divide it by 2 to find the average of what it's going to be worth on the first day and the last day. And $150,000 divided by 2 is $75,000. For Project C, we do the same thing. The initial investment that we have in Project C is going to be $80,000. Its residual value, according to our info, is 0, which means it's going to be worth $80,000 on day 1 and 0 on the last day. Well, if we divide that $80,000 that we get, our subtotal, by 2, we find out that on any one given day in Project C's life, we're going to have about $40,000 tied up in that particular project. Going down to Project D, and on Project D we have an initial investment of $200,000. The residual value of Project D is also 0, which means that our subtotal is going to be 200,000. It's worth $200,000. We have $200,000 tied up on the first day. We'll have $0 tied up on the last day. Well, if we divide by 2, we find the average of those two numbers, and the midpoint between 200,000 and 0 is 100,000. So our average amount invested in project D is going to be 100 grand. Project E has been eliminated. On to project F. We go through, we check our project info one last time. For this particular project, our initial investment is 60,000. On the last day, we're going to have about $5,000 in this particular investment. It's residual value, giving us a subtotal of those two numbers added together, which is 65,000. Well, if we divide that by 2, we figure out that if we're going to have $60,000 in value tied up in project F on day 1 and $5,000 on the last day, the midpoint, the average of those two numbers, is going to be $32,500. So now we go through and we check the ARR of each of the remaining projects, and we do so by dividing the average annual income that we determined in step 1 by the average amount invested that we found in step 2. So for project B, our average annual income above was $13,333 per year. Its average amount invested was $75,000. And if we go and we divide 13,333 by 75,000, we come up with 17, I'm going to hit the percentage button to turn this over and increase the decimal, 17.78% is our accounting rate of return on project B. For project C, that project's average annual income was $2,500. We're going to divide that by the average amount invested, which in project C is $40,000, and $2,500 divided by 40,000 comes out to be, in percentage, 6.25%. So project C in any given year is going to return about 6.25% of what we have tied up in it at that given time. For project D, we have an average annual income of 20,000. Looking for it, there we go. Our average amount invested on any one given day in project D is going to be 100,000. So if we divide our average annual income by our average amount invested, we come up with, when I convert it to a percentage, 20% on the dot. So our average income every year from project D is equal to 20% of what we're going to have tied up in it on any one given day in the project's life. And then lastly, we have project F. In project F's average annual income is 5,000. Its average amount invested is 32,500. And if we take 5,000 and divide by 32,500, we come up with, in percentage, 15.38%. So we have the ARR for our 4 remaining projects. Just like we did with Payback, our company, Orion Telescopes, is going to set an acceptable amount that all potential projects, in this case, must exceed. So what is Orion Telescopes' minimum requirements? Well, their minimum required accounting rate of return is 12%. Project B has an ARR above 12%, as does project D and project F, but poor project C over here with its 6.25% accounting rate of return is no longer acceptable to us, and we get to disqualify project C from consideration. So we're whittled down to 3 projects, and we're going to determine what project or combination of those projects that we can afford is the best using the net present value method.